Hi, everyone, and welcome to our next masterclass from Latham and Watkins, Masterclass M&A, a refresh from the current market. Before I hand you over to Robbie McLaren, we're just giving everyone a couple of minutes to get into the session. Whilst we do that, a couple of admin points to ensure that the session runs as smoothly as possible for everyone involved. So as you can see, Robbie will be giving a presentation during the masterclass. If you have any questions for Robbie, we do hopefully have time at the end to answer them. But I suggest that you either put them in the chat function, which, as I'm sure most of you know, is at the bottom of your screen. So you can either put questions in there, or alternatively, but you probably will be waiting, as I said, until the presentation, if you do this, has finished. There is a reactions button also at the bottom of your screen. If you click on that, you can press raise hand. And obviously, when we get to an appropriate moment after the presentation, Robbie or myself will come to you and you can ask your question that way. So without further ado, I know no one's here to listen to me speak. So Robbie, it's over to you.
Thanks very much, Becky, and thank you to you all for joining. If there is, also be great to take questions at the end. If there is something super pressing that you just cannot wait to hear the answer to, I don't mind you jumping in if you have to. So I'm not sure if Masterclass is perhaps overselling this, but it's really just, I think there has been over the last 18 months, 2 years, as we've run into the pandemic and hopefully now coming through the back end of it, what has changed when it comes to negotiating and executing M&A deals. And I suppose a quick question as to how much of that is temporary and how much of that is going to be a permanent feature of the market. And clearly, you know, in life sciences and healthcare more generally, the disruption caused by the pandemic has really accelerated change. And some of that acceleration and change is reflective of, or is reflected in, I should say, in how M&A is now being done and executed, and deals getting closed. So if without further ado, we'll just move on. I think there's 5 key topics that that I'll touch on. The first one is knowing who your counterparty and your competitors are. You know, the nature of counterparties has actually changed through the pandemic, and that is going to continue to be a feature. The second point is the speed of execution. With the increased number of people in the market and buyers and sellers, speed of delivery is now a mission critical item if you want to be a buyer, and we can talk about how that is impacting on your strategy for doing M&A. Thirdly is the outsourcing of risk. A huge amount of what would ordinarily be sell-side risk is now being you know, people are washing their hands of it either through insurance or being negotiated away, and we'll talk about how you can get prepared for that as a buyer. Number 4 is limiting tail end responsibility. Product divestments, carve-outs, TSA periods, and everything, and other transitional arrangements are getting much shorter and are less all-inclusive, and a huge amount of transitional risk is being pushed back to the buyer. And then last one, which I touched on, must have been last year, I can't believe that time has flown, is the impact of FDI risks on transactions. And this is something that has been accelerated by the pandemic, but I think is not going to be unwound as a consequence of the pandemic coming to an end. And we can talk more again about where that's going to be a problem and frankly, how much of a problem it is. So moving on to the first question, your counterparty and your competitors. You know, what has changed during the pandemic and after the pandemic is, you know, we've always had private equity purchasers, in particular of specialty pharma business or healthcare related services businesses, and they have even more money than they have ever had, and as a result they are moving very, very quickly in the market. What they are now also coming up against is that you have very well capitalized, frankly, and very lightly staffed and kind of high conviction buyers in the shape of venture capital backed businesses who are raising record amounts of capital, as well as SPACs who are also highly capitalized. They can give deal certainty, but closing takes a long piece of time. But they are out there and they are around, and they can be a form of capital raising and an IPO at the same time. So have a kind of two for the price of one moment. And then combined with that, you have your kind of existing corporate and strategics who clearly, at least for example, in biotech, were usually the exit opportunity of choice. And what we're getting or we're seeing from these corporates, and you're seeing it in the public markets, is an increasing focus on therapeutic areas and an increasing conviction in buying earlier stage companies than you would have historically seen them. And that's been driven by competition, of course, but it's also been driven by the fact that, you know, phase one or early phase two companies can now actually go public and list on the US markets or do a de-SPAC transaction. And as a result, you know, your large pharma companies are having to go earlier in the process. The key thing is clearly just to, depending on which side of the fence you're on, really know your counterparty and know who you're dealing with, and be prepared for what the levers that they will need to pull. So for example, a corporate strategic is going to be very focused on the key diligence in the high value assets, and particularly in the scientific assets and the compounds, but they may well be less interested in any of the operations or the back office because they will all be kind of synergized, if you like. Whereas on the flip side, a private equity buyer, if the business is operating, is going to be, yes, focused on the science, but super focused on how does the business operate, where are its operational efficiencies, and how does it convert kind of profits into cash. So moving on to the next slide, or the next topic, is speed of execution. If you've at all been involved in any kind of M&A transactions over the last 18 months, you will know that things have the potential to move very, very quickly. And processes that would historically, or not historically, in recent memory have taken 3 months to 4 months, are now taking 4 to 6 weeks, and sometimes even quicker. And the question for people who participate in the M&A market is, how do you get ready for that? So the first and obvious thing is just to be prepared. If you're looking to sell a business, there is a lot you can do in the front run to make sure that even if you have a kind of carefully structured timeline as to when you want your deal to sign, you need to be ready for somebody to kind of gate crash the entire process. And you want to, in that situation, be negotiating from a position of strength, because clearly if somebody is looking to gate crash the process, then the company or product is attractive. And as a consequence, if you have the information ready or have it well to hand, then you can maintain that position of strength. So as a seller, you can do vendor diligence, be it financial or product related or legal. To the extent you wish to utilize warranty indemnity insurance or rep and warranty insurance, we can get onto that a bit later. You can kind of assess the market on a confidential basis and make sure that the deal is kind of insurable, which will again speed up the process. And more critically, and we get onto this later, is packaging up and preparing whatever the turnover figures are or HSR figures are for the antitrust analysis, to make sure that when a buyer is offering you a compelling price, you know that it is deliverable and that the deal will close, rather than there being some unknown antitrust issue at that point in time. Similarly, on the flip side, through the buyer, do your antitrust or FDI work up front so that you can at least frame any substantive issue and how you're going to deal with it, be it by understanding what the divestment opportunity looks like, if that's what has to happen, or being comfortable with the categorization of the market where there might be an antitrust issue. And similarly, if to the extent there is an auction process, do your diligence on potential other bidders. One way or other, you should be able to get a good idea as to who else is participating. And it can be very useful to figure out what the antitrust position of the other bidders might be. Also consider, if you know that you are a large corporate and you're up against a private equity buyer, they will have a much more tolerant approach to how risk is allocated in the purchase agreement, and you will need to consider whether or not that's something you can also deal with to make your bid as attractive as possible. And also, to the extent you can't figure out who the bidders are, consider who else other bidders are likely to be using from an advisor and banking perspective to understand to what extent they are familiar with the type of asset being divested, be it a product deal or the TSA or the MSAs that need to go along with product divestments, and try and understand if you can present yourself as a sophisticated and experienced acquirer of such businesses. So you've prepared as much as possible. Clearly, you then end up in this mad rush to get to signing. And what the other approach or the other tool you can use in order to make sure that you get to signing as quickly as possible is to back end as much as you can in the gap period. So to the extent you need to raise finance to do the acquisition or bringing in co-investors, ideally you will be able to get some kind of commitment if you need it. And then you will roll out the long form documents in the period between signing and closing, be it long form shareholders agreements or long form debt agreements, just to make sure that you don't end up losing the prize because you're just getting your capital structure in order prior to that point. Similarly, many buyers now at the moment on very sizable transactions are only implementing warranty and indemnity insurance after signing. So they are taking the risk of there being a claim immediately after signing and before they get the policy in place. Again, if there is sufficient vendor diligence provided, then it may be that you're in a position that you're comfortable with that. And again, if there is buy-side diligence, ideally you're trying to push your debt providers and your warranty indemnity insurance providers, if that's being used, to simply rely on the information provided by the seller, rather than have you do a further crawl over all the information that's provided. And then the last one is taking antitrust risk. And this, by and large, means committing as a buyer to some kind of hell or high water obligation, or at least to agreeing to divestments or other remedies that solve any perceived or understood antitrust risk. This one is clearly a challenge for businesses who are buying competing products, because there is, in particular in the US, huge uncertainty as to the approach of the authorities to kind of competitive acquisitions, if you like. And there has been a bit of a pause for breath with respect to who is taking antitrust risk. But ultimately, if the sell side or auction process is competitive, there will be someone in there who is prepared to take the antitrust risk, and that position just needs to be managed. Lawyers hate shortcuts, but there are shortcuts that you can take. Oftentimes, if it's a private equity asset, there may well be old diligence that's been done on the business that you did when a company looked at it 3 or 4 years ago, or when there was an IM or some kind of investment opportunity for a biotech deal. You can look at these things. You can, as the seller, agree transaction docs with one bidder and then shop the documents to every other bidder and see whether they'll take it or leave it. And then as a buyer on the flip side, if you're happy with the deal and you're keen to proceed, you can proactively offer to sign something that someone else has agreed to. You can just take a commercial approach to the warranties and disclosure and just deal with it all post-signing, as we talked about. Or similarly, look for comfort elsewhere. If your seller is a private equity firm or a founder and they are willing to take equity in the future business of a significant percentage, does that give you a huge amount of comfort? Similarly, if it's a low risk business, is it healthcare services where it's already been owned by multiple different buyers and there's a limited claims history, or is it a listed company that you're buying and there's very little kind of negative disclosure. See if you can take a kind of commercial approach to these things. And similarly, if you are buying just a product or a collection of products, they tend to be dealt with on a, your watch, our watch perspective. Do you need a huge amount of diligence in that respect? Do you need to worry about all the warranties that you'd be given the nature of that indemnification? And then similarly, if you turn up and the buyer delivers you a fairly fulsome vendor diligence report from a law firm or an accounting advisor, which is of good repute and is long enough, if you're happy enough to read that over the course of a week and just proceed on that basis. Sellers, as we've talked about, are increasingly getting themselves well prepared for fast-paced execution. And as a consequence, they are investing more in these kind of sell-side products. Question is to what extent it is a kind of rigorous scrutiny of the information provided. I'm sure none of it's wrong, but they don't tend to offer kind of solutions-based diligence products. So the third topic to talk around is the outsourcing of risk. And we've touched a bit on this already, but the insurance market is increasingly happy to step in and try and provide an insurance solution for either ordinary course M&A risks or unusual M&A risks. And this kind of falls into two buckets, which is you've done the diligence and you've prepared your risk assessment. So we have the traditional solutions, which is the where risks would ordinarily be borne by the seller or the purchaser, such as diligence, warranties, indemnities. And then that is then outsourced to transactional insurance. Now, the rise more recently, everyone's familiar with W&I. It's kind of talked about almost on every kind of transaction these days, and implemented in many of them. We have the traditional piece on the left-hand side of the slide as we look at it, which is unknown and unforeseen loss arising from a breach of the warranties, or sometimes the tax indemnity or the environmental indemnity, or what it is. What the insurance companies are now offering is what they call special risk insurance, which is more unusual risk insurance, I suppose, which is when in diligence you have discovered a problem and the seller is simply not willing to take responsibility for it from a holdback or escrow perspective. And they are the insurance companies are expanding what areas they are looking to cover. So it started off as a product whereby there was this issue when you were indirectly acquiring a business in India, and the Indian government would claim capital gains tax or some kind of tax on the capital gain in the perceived value of the Indian business, even though it might well not have been an Indian deal. And that risk was then ultimately insured. And they insured a lot of those kind of risks. And it's expanded from beyond those into other tax areas, but also into environmental issues, also into big litigation problems or regulatory problems, although regulatory issues are tougher we can talk about, and also into cyber and data privacy problems. So they're really trying to fill the gap, if you like, or fill the risk problem that can exist between purchasers and sellers. A couple of differences. You can pre-underwrite a W&I deal we talked about when we talked about being prepared. You can do it quickly and you can initiate it or do it post-signing if you need to. And you can get quite buyer-friendly limitations excluded from them. I'm not sure how much these are worth, but that's my view. Whereas special risk insurance is much more time consuming, is always assessed on a case-by-case basis. It requires a lot of diligence, and ultimately some advisor will need to confirm that they believe the risk, so the probability of the risk materializing is less than 50%. And depending on what percentage that is, I suppose, will impact on the expense of it. It can be very expensive. If you're trying to do it as a solution for an M&A deal, in particular on the environmental side, it can take months to deal with. I've seen processes where these kind of issues have been uncovered, just be stalled or iced or delayed by a year whilst they try and solve this problem with insurance on their own terms without the rush. And you also really don't know upfront what the terms the insurer will provide. They will always be very bespoke. And as a consequence, you may think you've solved the problem with insurance and the pricing and then see the terms and not be happy. So it's still not a hugely common thing, special risk insurance, but it is moving into more and more areas. The area where they cannot or will not provide insurance is on things like sanctions and FCPA risk. And similarly, where there are, I suppose from their perspective, highly public regulatory investigations, such as the opioid crisis going on, the opioid investigations that are going on in the US, or CMA investigations, they've not yet found a way to get comfortable with covering those risks. Okay, number 4, limiting tail end responsibility. In particular in life sciences transactions, or even more so when it's just a product deal, you will always need some kind of transitional services arrangement. And the period within which sellers are willing to provide those is shrinking quite drastically from 2 to 3 years to a year tops. And the pricing for whatever transitional services being provided can be on quite a drastic escalator if you end up taking more than the kind of super aggressive 6-month transitional period that everyone pretends that they can get to. This is clearly some upside, if we're honest, for kind of corporate or strategic purchasers. They will inevitably need less transitional help, or at least shorter periods, whilst they transfer the products and systems, products and assets onto the regulatory systems, and that is a positive. It does require them to move very quickly, however, and to the extent you are a serial purchaser, they may well just end up having to join the queue of products that are being transitioned across to your system. But that is an advantage. There are clearly TSAs are not just, or MSAs are not just related to IT and other support services. There's going to be the regulatory regulatory services required, and manufacturing and supply agreements will still go on for a significant period of time, but there is a definite desire for those to be transitioned quicker in terms of how pricing is structured in those arrangements. The important thing is, if you are a seller and you're anticipating some kind of carve-out and TSA, is that you as a seller present a clear path to separation and to closing and then beyond, so that when you approach the discussion with a buyer, you can give them a plan and you can cost it, and therefore you can credibly tell them why it should take this period of time and why it's legitimate for there to be some kind of escalator on the price if they delay further, or other kind of guillotining effect on the services being provided. It is a very hard discussion clearly to have, where you're asking somebody to lose a service when you yourself have not been sure how long it will take to transition it, or even you yourself not even aware that you had to provide that service. Okay, TSA trends. We do a Latham & Watkins, we do a private M&A study every kind of 18 months. And so these stats are from the 260 deals that our European M&A group looked at, ending in June 2020, so the first part of the pandemic's captured. There are 23% of deals required a TSA, and they're kind of equally spread across Europe. Clearly, I think no big surprise that private equity are, smaller users of it on the sell side. They like a clean cut. They want to be off and done and be able to return the capital to their investors. And the nature of corporate buyers and sellers are that they will inevitably trade products in therapeutic areas or territories or divest themselves out of business units as and when you go through things. So it's no surprise to see a greater number of those. I think, or I suspect, in the next review period, we're going to see an increase in the number of TSAs, given just tangentially what I'm seeing, as that continued focus on products and therapeutic areas and territories gathers at pace. And we see a lot of divestment activity continuing there. And then the final point that I was going to touch on in the talk today is on the impact of FDI risks in the life sciences sector. So what is, I suppose, foreign direct investment screening? Historically, the regime was, at least across Europe and US, was relatively permissive, and that the governments only intervened when there was a competition issue or a perceived competition issue with a transaction. Historically, then CFIUS and FIRMA, which came into effect in 2020, expanded the scope of what was looked at to screen transactions on the basis of national security and other non-competition related grounds. And that process was, as we've talked about, or you will have seen, accelerated during the course of the pandemic, as governments who had kind of been thinking about jumping on the FDI bandwagon that had come before the pandemic accelerated their programs to ensure the robustness of their drug discovery pipelines, their diagnostic infrastructure, their manufacturing infrastructure, to ensure that they weren't selling off critical assets to maintain their kind of public health response to the pandemic. So this has led to a flurry of regimes. In particular, we've got the new EU FDI regulation, but we also have EU member state FDI regimes in Austria, Germany, France, Spain, and Italy, who are the most active, plus the new UK regime, which officially eventually comes into force in early January. And then similarly, other nations that had existing FDI regimes, principally the FIRB in Australia, there had been a kind of dollar threshold in order to trigger a FIRB filing in Australia, and that was now being reduced practically to zero, and which has resulted in a huge increase in the number of mandatory filings. In particular, similar strategies and tactics have been used in New Zealand, Japan, India, and China. So what they're concerned about, it's kind of fairly obvious. Outside of the pandemic response, they're wanting to protect against risks associated with the acquisition of critical infrastructure. The next kind of unicorns is the thing, or decacorns is also what they're worried about. And also trying to capture companies that may have very little revenue in your territory, but hold highly sensitive information, including personal data. We've talked about the ability to respond to the pandemic crisis. There is often domestic economic policy driving this, in particular post COP26. We're seeing a lot of companies talk up their nascent hydrogen businesses or their battery businesses or what have you. Those will also be captured by these regimes. And then there is clearly the kind of geopolitical overlay, which kind of will depend upon how relations are between various countries across the world. As we approach, more domestically in the UK, the National Security Investment Act requires, if you buy more than 25% of a company in the UK which is active in any of the 17 sectors, then you need to make a filing if the transaction is not closed by the 4th of January 2022. If you're trying to do a deal, I suggest you get a bend on, because this date is coming up fast. And there are a couple of areas that are relevant to life sciences companies. Synthetic biology is the most apparent one, but there are other areas, certain types of AI businesses also are captured. So it's important to run the rule over the company that you're looking to buy or sell to see what, if it is captured in the sectors. It is at the moment still pretty vague, and it's tough to be absolutely definitive in all circumstances as to whether or not you're captured. And then the other change that got a bit ignored is the amendment to the Enterprise Act, which was historically the way that the UK government could intervene on transactions. And they just put in a public interest ground, which is the need to maintain the UK capability to combat the pandemic. In terms of what we are seeing, again, this relates to our recent study. At the moment, only 15%, well, not only 15% of deals analyzed in 2021, so this is from June 2021 to July 2019, required an FDI approval as a condition. That's up from 11% in 2020 and 10% in 2019. That number, I think, is going to rise to 30+% in the next review cycle, I suspect. I suppose, interestingly, if you care about this kind of stuff, FDI conditions are more commonly seen in deals with PE buyers than corporate purchasers. And that's principally due to who the big investors in private equity funds are. They tend to be sovereign wealth funds or pension funds who can be associated as proxies of a national government. That is always one of the big triggers for an FDI filing. Again, the bigger the deal, the more common it is to have an FDI filing. And 26% of all FDI deals, FDI conditions that were seen on transactions were in the healthcare and life sciences sector. So it is clearly the most important or most impacted sector by the new FDI regimes, and it's important to get across it. Those in Europe that were the most commonly filed are France, Germany, and the UK. And this is just simply a direct reflection on the changes in the regimes in those territories that have come in over the past kind of 18 months. How do you deal with FDI? I mean, you should, by and large, be able to screen your potential buyers quite well if you're looking to sell. And similarly, if you're a buyer, yes, the first time you have to do this process is going to be painful, but ultimately you should have a very good idea once you've done a couple of transactions and run the slide rule over the relevant regimes, where you're going to see repeated filings coming up. And once you've done the kind of painful information gathering exercise once, it's less painful the second time. And similarly, the regulators are taking a slightly, I don't want to say more relaxed because that's overselling it, but they are familiar with repeat filers, if you like. And there has been a discussion whether it's possible or not to generate some kind of European-wide whitelist of investors who will have to do an FDI filing but will get given clearance in short order, but that's still kind of under negotiation. Again, you need to understand the implications for the transaction timetable and the risk of an intervention. If you are simply selling to a large European private equity fund who just has some sovereign wealth funds in as their limited partners, you may be comfortable that because the transaction is being run and managed by your private equity fund in Europe, that everything's going to be quite straightforward. If you're selling directly to a sovereign wealth fund or to a state-owned enterprise from certain countries, you may be much more concerned about the timetable and also the risk of intervention. Similarly, if you're looking to buy a significant business and need to raise capital from a third party, you should really be aware and familiar with what their FDI status will be, so that you don't end up ruining your chances to be a purchaser simply by the choice of your co-investor. And in certain circumstances, given how nascent these regimes are, you are able to open a dialogue and have a discussion with the regulators in advance to talk about how they will perceive a filing. What do they think of you as a buyer? What can you do to sort of allay their concerns? And they are open to this dialogue and are happy to receive, briefing memos or what have you, with respect to you as a buyer or the proposed transaction. And if you think there's going to be a problem, consider what remedies or undertakings can be accepted and what the potential impact will be. Okay. And then finally, on a similar basis to hell or high water, you need to understand to what extent you will require a buyer to do everything in their power to satisfy the FDI condition in the acquisition agreement. That seems to be the way the market is. If you agree to hell or high water on an antitrust condition, you're expected to do the same on an FDI condition, even though the risk balance or the risk assessment may be completely different. And that is all you have from me. If I stop sharing and we can see if there are any questions.
No questions at the moment, Robbie, but now is obviously a good time to put some into the chat. If anyone does have questions for Robbie, we've got about 5 minutes left of the session, potentially, if anyone has anything. The presentation will be made available afterwards, but obviously better to get them in live than have to go through sort of a slide deck afterwards. So, or maybe everyone's digesting. Similarly, if you'd rather sort of send questions or queries to Robbie directly afterwards, I'm sure Robbie will be happy to answer them. But again, use him now whilst you get the chance. Although having said that, if there aren't any questions, then Robbie, I don't know if you've got final thoughts. Obviously, that was a pretty comprehensive slide deck. So, yeah, any last thoughts? Obviously, if no one has any comments for you.
No, I mean, I suppose my only thought is I hope the frenzy calms down a bit for next year. Just from a personal perspective.
Yeah, exactly. I think all agreed. So, onwards and upwards definitely for 2022. So, okay. Well, if no one has any questions for sort of Robbie at this moment in time, we'll obviously sort of end it there. But thank you so much, Robbie. Very insightful. As I mentioned, sort of this will be available afterwards. So sort of all of that fantastic content you can digest at your leisure as well. So thank you so much for joining us, and enjoy the rest of your day, everyone.
Thanks all. Cheers. Thanks, Becky.
Thank you.
Thanks very much.
Thanks. Bye.